We start today's market talk. If you see the governance blow-ups of the last few bull markets, Byju's in the present one, Yes Bank earlier, DHFL, last one, Island FS, Zilingo. Every bull run has had one such case. Why do intelligent investors lose money? And get trapped in these blow-ups because simply they don't ask the right questions. And even now, people are not asking the right questions where I feel that there are blow-ups which are likely. They ask how much is the total addressable market? What are the future projections? Which I'll show you today also in one of the companies are just too fantastic. But instead of asking who is the promoter, is the management trustworthy, what is their past record of performance, and then they also start asking how much high can a stock go up instead of asking how long the earnings growth can continue. So the first step should be to avoid disasters or major mistakes by trying to understand the business, understanding promoter quality, and avoiding big landmines. Now, coming to market outlook, this week we will see the US elections and its repercussions will ripple across the world. Trump is seen as business friendly and has promised hefty tax cuts, while Harris has said that she will incur capital gain tax and other taxes on the rich. But that will not matter in case there are high tariffs and fiscal deficit is higher, which will lead to trade disruption, higher inflation, higher interest rates, and stronger dollar. So a Trump trade ahead of elections have already pushed up US bond yields and the dollar. Now, it's a point to understand is that despite a 50 basis point rate cut, US yield has moved from 3.5 to 4.3. So they are already pricing in higher uncertainty. It can lead to volatility in forex markets with China devaluing the renminbi to protect its exports. Big impact will be felt on trade. Trump victory is actually US dollar positive and emerging market negative as Trump's policies are inflationary. It will de-accelerate the US Fed's pace of interest rate normalization, impacting fund flows to the emerging markets. Now, anti-China bias of the US administration will impact India. Now, what will be the impact on India? Trump's regime could mean restrictions on H-1B visas, stricter implementation of patent intellectual properties. It will be challenging for Indian IT and pharma companies. China plus one theme will gain prominence due to tariff differentials, but there is also a possibility of China's dumping in India, which would be a collateral damage. Now, the other point to note, which I'll show you later also, US bond yields have spiked from 3.5 to 4.38. That is roughly 90 basis point, despite 50 basis point rate cut, because they are not anticipating rate cuts in future. US dollar and gold have rallied to record highs, basically due to money moving to safe havens. Nifty VIX has also spiked. Protectionist approach to trade and strong stance against immigration could affect India's exports. Now, the only good part is that domestic investors have continued to cushion the market decline, but will they continue? Indian markets have managed to withstand selling pressure from foreign investors due to buying from domestic institutions. What unsettles the market is concentrated buying or selling. So, in case there is a selling in a short time frame, then the market tanks like what we saw now or what we saw during COVID time. SIPs have gained traction in India. As long as SIPs continue, the mutual funds will support the market and keep the correction shallow. But if SIPs slow down over extended period, it will introduce volatility. A sharp cut in analysts' earning estimates is set to drag the market lower. Now, this, in my opinion, is the biggest problem which nobody is talking about. That is earning downgrade. Non-financial corporate sector has shown lower sales growth. There is report of slowing urban demand and improving rural demand is also due to higher borrowings only. RBI is clamping down on MFIs, which will affect rural consumption. Bloomberg Nifty 2025 estimate in September was 1,120 rupees for Nifty earnings. for FY25 and has been lowered to 977 rupees now, which is a significant downgrade. So one has to be uh, bit careful now. Now, what are the signals which are emanating? One was rising inventory of autos with dealers, evergreening of loans by MSMEs, personal loans, warning by RBI, and what happens is if the borrowed money is put into stock market, which is coming down, there is a high risk of delinquencies for the money which has been borrowed also from various institutions, NBFCs and banks. So every time there is going to be a rally, there will be supply at high levels because people are stuck and they will look to get out. And hence, the till the time the supply is not fully absorbed by force of liquidity, the markets will remain at these levels. Now, the stocks which are most vulnerable are the ones which have high market-wide positions. On all panic days, they would be the most vulnerable because they are the ones where people will close their positions too quickly because of panic. Uh, Also, it is seen all over the world. In 2024, there were too many elections, and there is too much of enthusiasm, and there is a tendency to always project good data. But it will come out subsequently that enthusiasm was misplaced. And bond yields across the world are rising. Uh, Indian indices that is Nifty and Sensex have been led right now by Bank Nifty. So US indices are falling. Market-wide position limit is now the lowest for 5 months, and people are not taking positions. Now I'll show you this data. Nifty and Bank Nifty were generally up last week from the lows. Gold was also at generally the same level. Silver corrected a bit. Crude oil corrected. Uh, Dollar was flat. USD INR was up. India's 10-year bond yield slightly corrected. NSE market cap went up. So basically, this is Nifty and all had gone up. Market-wide position limits, if you see here, has come down to below 30% because after the expiry, so it generally comes down, but not to these levels. Dow Jones, Nasdaq, and S&P 500 corrected. I'll cover that. So coming to US indices, Wall Street's bull run took a hit this week due to mixed earnings from mega cap tech stocks like Alphabet, Microsoft, Meta, Apple, and Amazon. Alphabet delivered good top and bottom line results. Amazon gave good revenue guidance, but investors were not happy with Microsoft, Meta, and Apple's results. Advanced estimates of US Q3 GDP inflation and October jobs report showed a continued deterioration in labor market economy that is chugging along and inflation which is not fully under control. It is we have to see whether the Fed delivers another rate cut or a small rate cut or I don't know what happens next week. Now coming to US bond yield. So if you see, it had come down to around 3.5. It has come down to 4.386 level. It has quietly changed the direction and now it is heading higher. And with that, the dollar index is also going up. It is now testing that declining trend line. If it breaks out above this, then that would be a decent retracement will take place. Brent crude is generally flat, has not moved much. So there is a balance between supply and demand. Gold also halted its upward journey, but it made a fresh high. So we'll have to see what happens. Copper again corrected last week. So there is nothing much as expected from China. So this rally is also stopping. It is coming to the 20 EMA. So we'll have to see what happens. Nasdaq corrected based on results. Dow also has corrected now for the last 2 weeks. So we'll have to see as to, and basically this is because of, again, impending uncertainty in the US. India, now coming to our indices, India VIX is going up, and this should be a sign of worry because even on 1st November, the markets opened gap up and India VIX still had climbed. So this is a point. It's reaching 16. basically because of too much of uncertainty and people taking too much of hedging of their positions by writing calls and all that. Now coming to Nifty, uh, it is it on even on a weekly chart, it is below the 20 weekly moving average, and it kind of made a doji. Now if you see, this is the second swing low, so this level of 23,900 odd becomes very crucial for it. And it has been it was seeing 4 weeks of decline, so last week it stabilized a bit, so we'll have to see. But below 20 EMA, it is weak on the weekly charts. Short term outlook is slightly nervous. Now coming to daily charts. So if you see now, this was the earlier at this point was the earlier head and shoulder, and it has broken through that neckline. So the head and shoulder actually starts working if it breaks the neckline by around 2%, and it has broken that. Now what is happening is another head and shoulder is forming. So if it dips to around these levels, this was the second swing low, then that head and shoulder will be formed, and then the next target will open up to closer to the lows of the election day. Though it may not happen in one day, but what happens is, moment this 24,000 breaks, there is a pre-programmed trade start off, and then there is a selling which takes place. And there is a 200 EMA at 23,500 or 450. So there would be some point of support here, but let's see what happens with the how the events come up. But technically, once another head and shoulder is formed, the lower levels get opened. Hourly chart, it had got oversold last week, so bounced back, but generally remained at these levels. So on hourly charts also, if it doesn't closes above the 20 EMA, and the 20 EMA line is below all the other moving averages, so it looks relatively weak. Now Nifty Bank was the stronger stronger indices. Now on weekly charts, what it has formed is a inside week pattern. Right? See this candle of the last week. This week's candle is inside this. So it is showing indecision and not very clear where to. And also they were selling at the higher levels because it has got a big shadow. So there has been, it couldn't sustain the high level, but this is still better, and it is still above now, above the election day high. So if this thing gets broken, then it will become more weaker. Uh, on the daily chart, so if you see here, this was the low, this has been protected, but if you see here, it had one day, or Tuesday was that big spike, but after that it couldn't follow that up, and then has come down below the 20 EMA. So we'll have to see, but it has bounced back nicely from the 50 EMA and all. So that way it is okay. 51,000 is a critical level for Nifty Bank. Tuesday's rally, as I told you, gave some moment, and the neckline of that. If you see, you make a head and shoulder here, the neckline has not been tested, so it has bounced back from the neckline. So that way it is good. Let's see what happens. 51,000 is the one level to watch. HDFC Bank continues to be on the daily chart above the 20 EMA. So till this 20 EMA is not broken, there is no problem. It will continue to support. The weakness is in Reliance. It has come down, and it has come down now to that point from where the complete rally started. This up move started from this point, so which will start after the split. It is now at 1325, but that was around 2650. So this whole rally of January 2024 has been negated by Reliance, and it is basically due to selling by the institutions. RSI is nearly oversold. So the day it gets into that oversold zone, or the next dip, it will again bounce a bit. Nifty Midcap on weekly charts is also below the 20 EMA. So it is looking weak, but till the time it is above this election day high, it is okay. But there's not much of momentum here. It was the small caps which showed some momentum, and it has gone above the 20 EMA. And though it also had an inside weak candle, so it has to decisively break above these this candle's high so as to show some momentum. Now, overall, I'm covering two banks today, but first I will cover what is happening with the banks. Uh, First, outlook for banks. System credit growth is slowing and has declined to 14.2% year on year from 16.4% in 2024 as per the latest fortnight data, mainly driven by slower deposit growth and an elevated credit deposit ratio. I'll show you today, most of the banks are reaching that 80-85% credit deposit ratio. And after that, there is a generally a direction from RBI not to go above that. So in case they are not going to get more deposits, they will not be lending more, so there will be no growth. Now, gap between advances and deposit growth has significantly narrowed down to 2%, but deposit growth still lags loan growth. Deposit growth is range bound at 11 to 13% and is mainly led by time deposits rather than CASA, so the NIMs are struggling. Margins are expected to be under pressure due to elevated cost of term deposits, while a reversal in rate cycle could further lead to yield pressure. Overall, asset quality outlook is stable to positive for the sector, except for unsecured small ticket size retail loans and MFI. Banks with robust capital base, strong asset quality, and healthy retail deposit franchisees are well placed to capture growth opportunities. Now, I'm covering two banks today, both one in private, one in public. Both had the best results. So you will understand what is happening with banks. Now, Federal Bank, good set of numbers for second quarter. Net interest income for the quarter came in at rupees 2,300 crore, up 20%, 4% year on year and Q and Q. So that were strong numbers, which was broadly in line with estimates. Net advances grew 19%, 4% year on year and Q and Q. Similarly, deposits also grew 16 and 1% year on year and Q and Q. Pre-provision operating profit came at 1,570 crore, an increase of 18% and 4% year on year and Q and Q. GNPA and net NPA were lower sequentially at 2.11 and 0.6% respectively, with improvement in 100 basis points sequential improvement in PCR. Superb. Gross advances growth led by retail advances. Deposit grew by mere 1%, but management is confident of better performance going ahead. So this is a point of worry. Uh, Now coming to this chart will exactly show you exactly what is happening with the bank. Financial and valuation summary. Net interest income grew year on year 15%, 3.3% Q on Q. Pre-provision operating profit 18% and 4%. And provisions were up to 60%. So which should be a point of concern. And year on year and 9.8% Q on Q. So that means the trend of deterioration in asset quality is continuing. Net profit was up 10% year on year, affected because of higher provisioning. Otherwise, it could have been higher. Loan growth 19.4%, NIMs at 3.2. But if you see, they are declining now. So year on year, they are declining. Cost to income ratio is okay, fine. GNPA, asset quality is good. ROA is now 1.4, ROE 14.7. And it is not very expensive. I'll show you later. So AUM growth is strong. It's a strong uptrend. The advances mix is also good. Retail loan book, MFI, CVC, Gold, Agri. This is business banking, BUB, and COB is commercial banking and corporate banking. So there's a decent mix, not really oriented towards MFI or others. Asset quality trend is also improving. Provision coverage ratio is higher, so which is good. And the GNPA and NNPA are declining. Deposit trend is decent, around 15% growth. And term deposits are higher as compared to CASA. CASA ratio is stable at around 30 and balance is term deposits. Now, coming to their future growth, they are expected to grow their loans at around 18% for next 2 3 years, and deposit growth is also expected at 18%, which is looking slightly difficult, but this is what is their trend. So they are constantly maintaining margins and return profile, and they have this kind of a trend. So let's hope that it continued. But asset quality is the best in the industry, and there is a management transition which is taking place because they are getting a new CEO now. Uh, pre-operating pre-provision operating profit are also expected to go up around 20% plus. Names are expected to remain at these levels around 3.2 because as the rates decline, it affects the NIMS. ROA is decent, so it's not a problem. Coming to the ratios, book value in FY26 is 155 at around 200. Uh, this bank is at around 1.2, 1.3 times price to book, which is not very expensive with the quality of management and the quality of performance. Now, if you compare the with peers, so the best performing in this was City Union Bank. And if you see their price to book, they are at around 1.4, 1.3. And Federal is also at 1.5, 1.4 kind of thing. So it's decent. Rest who are at lower price to book, IDFC First, Bandhan Bank, RBL, are because their performance is poor. Now that you can compare with the help of these ROE and ROA. So if you see City Union Bank and Federal Bank have the highest ROA among this group of medium-sized banks and ROE also. So they are the best ones among them, and this is why their performance is also better. Now coming to chart at around these levels of 205 odd was the last high and it faced resistance and has come down. But in my opinion, this performance is good and use every big dip to get into this stock. After the results, there was a spike, but after that, because of market conditions, the prices are not going up. But there is a very good support at these 185, 190 level. So it's somewhere closer to these levels. It should be a good opportunity to accumulate this stock. This is a strong stock in a weak market. Now, the other stock I'm going to cover is Bank of Baroda. Now, among all the PSU bank, this was the best performing. Now, let's see this. Earnings significantly above estimates grew by 23% year on year. So, optically, it looks great, mainly driven by higher recoveries from return of accounts, leading to higher ROA at 1.3%. Sustainable ROA trajectory remains at around 1 to 1.1% for the bank. So, this time the ROA was higher because they did write backs. Treasury gains were at 799 crore versus 7295 crore Q on Q and 725 crore year on year. And other income excluding treasury gains at 2609 crore vis-a-vis earlier quarters led to higher recoveries from return of accounts. That's why the other income was higher and that's why the profits came in better. Total provisions were higher than expected, led by higher standard asset provisioning and contingent provisions created. NIMS declined by 8 basis point Q and Q on expected lines to 3.1. So there's not much of difference between the best of PSU banks and private banks in terms of NIMS. They are at 3.1 odd level, driven by lower yields on advances and marginal increase in cost of fund. Credit deposit ratio stood at 82% versus 80% Q on Q. So now it is reaching that upper limit. This is what I was referring to earlier, that the credit deposit ratio is reached that point. So now after this, any so they are now dependent on deposit growth for credit growth. Bank has lowered its guidance on loan growth marginally for FY25 from 12 to 14% to 11 to 13%, citing lower deposit accretion, although upside risk to guidance persists. Deposit growth is expected to be 9 to 11% versus 10 to 12% earlier. Hence, despite decent results, the stock is not running away anywhere. So there is no point chasing any rallies in these stocks. Higher retail orientation, reasonable capital position, and healthy asset quality outlook augur well for the future earning progression. Bank needs to ramp up other avenues of productivity, mainly fee income to drive ROA, ROE expansion. The The easier part for all the PSU banks is that the credit cost for them is lower as compared to the private banks. Now, coming to their chart, again, this chart will exactly tell you what is happening. Interest income grew 9%, net interest income was up 7% year on year and flat Q on Q. NIMs at 3.1. So Q on Q, they are declining. Core fee income was up, uh, and other income is also up. So core fee income is year on year declining, was up Q on Q. But the other income, which I told you comprises of treasury gains and the write backs of bad loans, is up, and that is what is causing improvement in profits. Cost to income ratio is still decent, has come down because of uh, all this write backs here. Hence, ROA was up, but they are saying they will get around 1.1 ROA only maximum. And asset quality is good, which is the good part. PCR is also decent, though they have done lesser of provisioning, so they could have done higher provisioning. Uh, Net NPA, gross NPA, and others are lower. So NIMs declined. Uh, Credit cost, as I told you, is still 0.75. Some banks are guiding to 2% plus credit cost. And some NBFC have come down to 4% plus credit cost. Advances grew 12%. Here, see here, advances grew 12% and 7% Q on Q and 12% year on year. Deposits grew by 9% and 4% Q on Q. So there is a mismatch there. Asset quality is stable. Now coming to their future projections. So if you see FY26, they are expected to grow decently in terms of net interest income, etc. And they are now coming for present value. They are below price to book for uh, FY26. So the risk reward is decent. ROE also is coming down. So that means they are not improving in efficiency. It is coming down only now. And ROA is also coming down. Now, if you see the pair comparison for between BOB and SBI, though size is different, but generally, if you see in terms of ROE, ROA, etc., they are at same level. And valuation wise, also, there's not much of difference. So, opportunity is in both is the same. Seeing the chart, it made a low at around 230, and from there it bounced because of decent results and because of the valuation. It had become very cheap at 230. So, but it is not able to go up from these levels. Right now, it is above 20 EMA. So, every dip is a opportunity in case you are looking for a safe place to park your money. Otherwise, it will not go back to that 300 level very quickly now, because future growth is doubtful now, and future earnings are also doubtful, though they are doing well. So this is, I'm talking about the best in PSU Bank. Others are worse than this because they didn't even have any growth. Now coming to Inox Wind, again, it's very interesting since you all remember the Suzlon thing. Management, as per Inox Wind, is likely to execute a target of 800 megawatt and 1200 megawatt for FY25 to FY26. That means they are saying we will do roughly 200 megawatt per quarter, with an upward revision in EBITDA margin guidance by 200 basis point to 17% for FY25. So what they are saying is we are likely to do 200 megawatt per quarter this year and 300 megawatt per quarter next year. It has bagged orders with cumulative size of 1.2 gigawatt during this year, FY25, which takes its current order book to 3.3 gigawatt. Now, Suzlon had 5.1 gigawatt, etc., providing execution visibility beyond the next 24 months. Company achieved a net cash position of 278 crore as of September 24. So they have cleared all their debt because the promoters have put in money. So that is a good part. Interest expenses are expected to reduce sharply because they have reduced their debt, with finance costs limited to LC-BG charges. LC is letter of credit and BG is bank guarantee, offset by investment income and surplus Cash management forecasts interest costs to approach zero by fourth quarter FY25. Royalty payments expected at rupees 6 lakhs megawatt are anticipated to cease after FY25. This is because they had taken the technology from a US company. So that is called American Superconductor for using design and technical expertise. So that royalty will also get over. So that will improve the margins. Progress underway for launch of 4 megawatt platform. So what they want to do is they want to make a turbine which can provide 4 megawatt of power. Annual capex plan is 75 crore over the next 2 years, focus on large blade molds to enhance cost efficiency. EBITDA margins reached 23.6%, an increase of 1,000 odd basis point year on year and 231 basis point Q on Q. This growth was mainly driven by high turbine supplies compared to EPC. So they didn't execute complete project but supplied the turbines. Now, see, from last quarter, they have doubled their order execution to 140 megawatt. And in last quarter also, they did 140 megawatt. So there is an improvement, but there is no growth Q and Q. So there is a pinch of salt as to how they will execute even 800 megawatt. So we have to see the next quarters and the guidance as such as to see how well is their execution, because right now the markets are pricing 800 megawatt of execution and 1200 megawatt of execution in the next year. Revenue growth was growth 98%, expenditure didn't go up that much, so the EBITDA improved by 258%. EBITDA margin says very good, 23.6%. Interest expenses have come down drastically, so which is good because they have reduced their loans. EPS, if you see here, for this year, for 2 months of this year, total is 1 rupee 10 paisa. So just remember that. I'll talk about now subsequent part. So for FY25, they are saying they will do around 4,500 crore. This is in billions, so 4,500 crore, and a EPS of 5 rupees 30 paisa, which to me looks pretty ambitious. And we'll have to see the Q3 how the performance is, because that will give, and there would be a revision. And FY26 they are talking about nearly doubling the revenue and EPS of around 10 rupees. So that is getting priced in the price that they have reduced, and they are net cash positive, so which is positive. But I think these targets are really difficult to obtain, because if you see, they have done 1 rupee 10 paisa for first 6 months. So that means they have to do roughly 4 rupees 20 paisa in the last 6 months, which is slightly looking difficult. And 4,500 crore, and they have done roughly 1,400 crore. So roughly they are expected to do a major part in the second half. Hopefully they should do it, but we'll have to watch this and just can't blindly take the management's guidance. Cash flow is improved now. Earlier they were negative, now they have improved their cash flow. So they are positive now, 150 crore and 310 crore next year. Year-on-year growth is strong, and they are expecting to have around strong growth over the next 2-3 years because of the demand. EBITDA margins are also improving and are expected to maintain at these levels. Earnings, they are saying, is around $10 in FY26. We have to see that. And accordingly, then you have to see what is the PE and all that. So the trend of revenue growth is strong. EBITDA has also improved, and EBITDA margins are better. PAT is also improving. There is a decent growth. Standalone revenue is also good, and it is improving. So for future, because of better execution, they are expected, as I was telling you, to nearly double their revenue every year. This has to be watched, and which will, when the operating leverage comes in, that will help the EBITDA to grow, also EBITDA and profit after tax to grow. We'll have to see this if they are able to execute it. They are guiding for around 1,300 crore of profit in FY26. So we'll have to see that. strong order execution is what they are guiding for. So they are guiding for 800 megawatt for FY25, and they have done roughly 280 megawatt till date. So we'll have to see how much they are able to execute. Cash flow position has improved once the promoters have pumped in money. Uh, they have a uh, they have a subsidiary called Inox Green, which does the operation and maintenance part. So their operation and maintenance revenues are expected to do well, and EBITDA is also expected to grow at CAGR of 30%, and revenues are expected to grow again at 33%, and PAT margin is also expected to improve now. Now see this Inox Wind. Uh, you see, once the promoters had pumped in money, this stock took off and has been steadily rising now, and maximum dips to the 100 EMA. So every time it dips to 100 EMA, that is an opportunity to watch, but I will still watch for next quarter result before taking a view, because revenue for Q2 FY25 was below estimate. So they executed less. Uh, EBITDA is higher due to higher share of equipment supplies, as I told you, compared to wind turbine generator commissioning. And the same thing is happening with Suzlon also. Royalty I spoke to you about. Now, what people are talking about is firm and dispatchable renewable energy instead of just standalone renewable energy projects where there is an integration with energy storage systems. So I have finished. We will take questions now.